Hi, Charles Cannon, Certified Financial Planner here for the Lifetime Income for You channel. We are back with Michael Guyette of the Lead Lag Report. If you saw yesterday's video, he talked about what's going on with Japan and with China and how they may have events and storms out there that can affect you at home. Michael's a portfolio manager at Tidal Financial Group with over $6 billion under management. Tidal is one of the largest ETF advisement firms in the world. He is also the host of the Lead Lag Report, which is where you can follow him on X. Michael, as we talk about these various financial storms that can affect the 30 plus years of retirement savings by my clients out there, they depend on income from their portfolios. And you've told us the credit event is coming here in the United States. What does that mean? We've been in inverted rates for some time, and now the 10-year Treasury is spiking. What does that mean for people at home?
Well, it probably means you're going to have an opportunity to get some even higher income, right? So when you have a credit event, what typically happens in those types of periods is the 10-year, 30-year type of Treasury yield, the safe, in quotes, safe collateral, drops in yield, right? Because there's a flight to safety. While at the same time, bonds which have credit risk end up, widening out and having higher yields. So junk debt, for example, triple C type paper, ends up yielding more because there's a feeling in a credit event that default risk will rise. So you got to compensate for that. Now, inevitably, there ends up being overreaction, in which case, sure, it will make sense to, I think, buy up some of these corporate credit type of issuances after that spread widening takes place. On the equity side, it probably means that sectors which are income heavy, like utilities, consumer staples, healthcare, probably on a relative basis do a lot better, because when you have high volatility, there's a feeling of risk around growth stocks. So play defense, go lower beta, go into the areas which are the blue chip, income dividend type of plays. So I think that probably ends up being the play. You rest of the idea of win by not losing through defensive allocations, and income is defensive, right? And again, I go back to everybody should welcome a credit event in the short to intermediate term, because it means there should be some better opportunities to get even more yield, right? After already we've had what we've had in the bond market take place.
Right. Do you feel like the spike we're seeing in the 10-year Treasury here is similar to just before Black Monday in October of '87?
Yeah, I mean, there's some parallels. Yes, that doesn't mean that you're guaranteed to have
right.
An '87 style crash. I've used that analogy before. That 1987 was a pre-election year like this year. You had a melt up in 1987. You had a crash in 1987. You had a positive year for the equity markets in 1987. And I only reference that because history has shown that you can have some pretty big moves within a 12-month time frame. Oh, and by the way, Fed pivot in 1987. So yes, I think spiking yields become problematic at some point, because if you're a business owner and you got to try to map out your plans for next year, how do you even know what interest rate to use to do a net present value calculation, right? To figure out what projects to take on if you can't even properly rely on stability in the cost of capital. So it could end up being a spark for an 87 style decline. It's not a base case. I mean, you're not gonna have it all one day, because you've got circuit breakers and all kinds of other structural dynamics, I think, that make the sequence different. But again, I go back to, risk happens fast. People forgot following last year that there's a reason why it's staircase up, elevator down, right? Meaning when risk happens, it happens very quickly. It happens like an event. And if that's the case, spiking yields end up then becoming likely to become crashing yields, because, the higher yields get, the more strain it causes, the more it then kind of becomes one of those situations where the cure to high yield is high yield, as people start going into it.
As these things happen, if we get more slowing, Chairman Powell came out with his comments last week. He said that he was a little bit surprised that the economy had not slowed more. To me, what I hear is that he expects that we've got to go into recession to get to where he wants to be. My view is he has said he doesn't want to be like Chairman Volcker that leads to double dip recession. He will be slow to ease when we hit recession. What are your thoughts about that?
I think if Powell were truthful to himself, he would recognize that he can't tell what's going to happen next, just like everybody else.
Yeah, right.
So we all have the same problem. Doesn't matter how smart you are and how much data you have. The reality is nobody knows what tomorrow brings, and it's hard to know anything except conditions, right? So I don't know. I mean, I think I think the Fed has to be careful, and I'm sure they're aware of the risk of being whipsawed, meaning, you still have elevated inflation and they lower rates when there looks like there's something happening, right? Mm-hmm. So who knows? I think it's unclear, but then it's also unclear how the market itself would react. The bottom line, though, remains the same. Powell's just reacting. He doesn't know what his next move is either.
Right. Okay, let's change topic, Michael. And there's one thing, and I want to point out, and I think you said this in yesterday's video, you're not a short position taker, so you're not trying to poison the stock, but rather provide information so people can make prudent decisions, right? But you've talked a lot about NVIDIA. They got so much attention last week. They had raised their forecast. They reported a great quarter, but you kind of feel like it's not sustainable. Is that correct, and why?
Yeah, and I don't have a position in it. I mean, I reference NVIDIA because I think it's funny, the media, just like a lot of the medias we've seen in the past, including the multiple cryptocurrency ones from 2021, looked like. Listen, those that have made money in NVIDIA, God bless. But let's call it what it is. I mean, it is a mania. I mean, you can't possibly use revenue as justification and then totally ignore price of sales. You can't possibly use earnings as justification and then not use PE, right?
So are they creating much a Y2K bubble?
I don't know. I mean, I think one of the major commonalities of every single bubble is you need a really good story, one that people can naturally gravitate to and understand. So the AI thing sounds really seductive as a story. It's like everybody can understand it. Yeah, it's all going to be artificial intelligence. It's not. It's just correlations, right? At a very sort of simplistic scale. And I do think that if AI really is a legitimate thing, it will take a lot longer than people think to impact, really impact society in our lives. So, listen, the fundamental dynamic. I'm not debating it for the company is real. The valuations, though, are not being driven by AI. It's being driven by people on FOMO. Mm-hmm. So I look at NVIDIA more as a symptom of a bigger problem, which is that you still have a lot of uneducated speculation, a lot of hype, a lot of hope, when the reality is AI is not going to be able to break your 7.5%, 8% mortgage rate. It's not going to be able to break $1 trillion of credit card debt with a tapped out consumer. So that to me is more the issue. People can make money on it. God bless. I'm not faulting anybody for trading it, but at least recognize what it is.
Right. Michael, that's such great information you shared with us the last 2 days and how it relates directly to my clients and our followers. Folks, you got to ask yourself, do you have the time to come back from a major economic event like what might be in front of us? Now's the time to protect your portfolios from these storms. Those who do not board up before the hurricane spend years cleaning up. Do you have time to do that? I'm Charles Canna, Certified Financial Planner. Remember, lifetime income for you is the most important part of your retirement.